And there will certainly be a lot of follow-up discussions and some strategic planning that goes into this or that comes from this tax bill. So I think, as far as, if you take some notes and just jot some things down, that's great. But we'll certainly be in touch with, our clients, certainly as the tax filing season gets going and providing some projections for 2018 and what that might look like. Obviously implementing some of these other business strategies. So there's a lot that we'll be following up with, with a lot of you. So
this is one of the biggest pieces of tax legislation we've had since I think 1986, which is actually when I started with the firm, was a big piece of legislation. So this is a pretty big sweeping legislation that we've got here, covering multiple different areas, both individual and corporate, and can handle trusts and some changes with the estate exemption amount. We're going to start out with the individual piece. We're going to talk about some of those changes. Mike's going to talk about those. And then we're going to move a little bit on what's happening with the estates and the trusts. And then I'm going to talk about some of the business changes. And some of the changes might relate to the pass-through entities or some of the deductions in the business area.
What we'll start with here is just going through the changes to the tax brackets. And we're going to go through these pretty quickly. I think a lot of you have probably seen some of this already. It's certainly been published, in a variety of different ways. So the first thing we'll go through is the tax brackets for joint returns. And the left-hand side of the schedule you see there marks the prior law. The right-hand side of the schedule marks the new law. Couple just, observations here. You can kind of compare and go down the left and the right side. But what we're seeing, as we run some of these projections out, if you look in that $300,000 category as an example, we're seeing some significant savings there. If you look at under the old law, if you were at $300,000 of income, you were paying a marginal tax rate of 33%, whereas under the new law, you're at 24%. So, depending on where you fit in, where your income fits into some of these revised brackets, you'll certainly see some greater savings in certain situations maybe than others. Also, once you start getting up into, the top rate now is over $600,000, and that's 37%. We've noticed too, once you start really looking up at the higher income levels, say $1 million or more, without factoring in some of the other incentives, you start to see some scaling back, and the tax savings is not necessarily as noticeable. And you combine that with, as you get above those $1 million levels, the loss of deductions, which we'll talk about a bit, has a pretty significant impact as well. The head of household tables, just one observation there. Kind of look at if you're looking at somebody making $180,000, under the prior law, they would have been at a marginal rate of 28%. Under the new law, they're at 32%. So this would be an example possibly of somebody, depending on what their other facts and circumstances are, they may actually end up paying some additional tax. So while we haven't seen a lot of these situations where taxpayers are paying more under the new law versus the old law, we do see some situations there. Again, there a lot of moving pieces to this, and we'll talk about that as it relates to deductions and whatnot. But just an observation there. Moving along to the the brackets for single taxpayers. First of all, if you compare this to the married filing joint table, the rates and the brackets, the brackets are about 1/2 of the married filing joint schedule, up until you get to the higher tax brackets, the 35 and 37% brackets, where things start to scale back, and there isn't very much difference between income as a single tax, or the marginal rate for single taxpayers versus married filing joint. For kiddie tax, historically, if you had children that were under 19 years of age or in college and under 24, they would be paying tax at the parent's rate on certain types of income, and that income was typically dividends, interest, capital gains, certain other types of passive income. Under the new law, there are just statutory tax rates that they will pay, which are based on the revised trust tax rates. So you can see that for those that this applies to, it would only take up to $12,500 of investment income for the kids. They're paying tax at the top rate already. One thing is the compliance will be a little bit easier on this. Historically, we always had to finish completion of the parent returns in order to determine what tax rate they were in so that we could apply that to the kids' returns and the separate forms they're in. But that is no longer going to be necessary, so a little bit easier. And I don't know that the tax at the end of the day is going to be noticeably different than what it was before. It really depends on where the parents, what tax rate the parents were in before. So you could be looking at just not much of a difference. For capital gains, so this is really the long-term capital gains tax, which would include tax on qualified dividends. No real changes there. Just putting it here in the presentation because I know a lot of people have asked, well, what are the there's obviously all these changes to the tax rates and brackets, and what does that mean for capital gains? And for long-term capital gains, there are no changes. Make note there, though, that the 3.8% net investment income tax, which is really some call it one of the Obamacare surcharges, that still exists. And again, that's imposed on taxpayers whose overall income, if you're married filing joint, is over $250,000. So your investment income would be potentially subject to that additional tax. But again, no changes there. That's still on the table. Like I say, there's been a lot of news, obviously, and one of the more popular items you hear about is the change to the standard deduction and personal exemption. I think a lot of you are probably already aware of this, but what we're seeing is effectively doubling of the standard deduction for most taxpayers and an elimination of the personal exemptions. And what this will do at the end of the day, especially as it relates to the change to the standard deduction, is that this will really have a tremendous impact on those who have historically itemized. So you couple this higher standard deduction along with a loss of some of the itemized deductions that we'll talk about in a little bit, and there will be a significant reduction in the number of individuals who are itemizing. And in some cases, this will even apply to some of the higher income individuals, depending on what their other items are. So certainly be a lot of change there. Okay, so moving on to some more of the specifics with these itemized deductions. The first item there is there's a suspension of the 3% of AGI limitation on itemized deductions. So again, under the prior rules or the rules in place through 2017, as an example, if you were married and your income was around $315,000, I don't have the exact number, but once you exceeded that income level, you started to lose the benefit for some of your itemized deductions. So that's a plus for the taxpayers. We don't have to worry about that, and those, to the extent your itemized deductions are eligible, there will be no phase out based on having a higher level of income. Second item there, the medical expense deductions are still allowed. One thing to note, so the 7.5% of AGI limitation is still in play for 2017 and 2018, and then it increases to 10% after that. If you recall, and there was certainly a lot of news about this, the House version had called for an outright repeal of this, but there was enough outcry for keeping it, and the Senate version kept this on the books and eventually prevailed there. So we still do have the medical expense deduction available. Third item there, this is the big one, and this is the one that will affect almost every one of our clients, I would say. Certainly, anybody, other than maybe some of the children's, returns that we prepare, is the combined $10,000 limit on the deduction of state and local income and real and personal property taxes. We'll talk about that in some examples, but that $10,000 limit is going to be tremendous, and it'll really, change some of the planning really that's done as far as when those items are paid and things like that. The mortgage interest deduction. No real change here for existing mortgages. So if you have an existing mortgage where the acquisition debt is less than $1 million, you still get a full deduction for the interest expense. However, going forward, any new mortgages, that acquisition debt limit is now $750,000. Another note on there is that refinancing acquisition debt would still be allowable up to $1 million. As far as home equity loans go, those will only, the interest attributable to home equity loans will only be allowable to the extent you have home improvements essentially. So if you have home equity loan for cars or boats, what have you, that deduction will no longer be allowed. That will completely be eliminated. And it's not grandfathered in like some of those other, the previous interest rules allow. So more itemized deductions here. Not much has changed in charitable contributions. They have changed the AGI limitation has gone up from 50% to 60% of AGI for cash donations. So we don't see that a whole lot where folks are limited to what they can contribute. The carryover, to the extent the donations exceed those amounts, the carryovers are still available like they always had been. Athletic ticket seating rights will no longer be deductible. That was a specific provision as part of this bill. Hopefully this is one that doesn't apply to too many folks out there. Is the personal casualty and theft losses has been suspended. There is an exception there for federally declared disasters. There's a few items there on federally declared disasters. Feel free to take a look at them if that's something that you know somebody or might apply to you. If you have property down in Florida that may have some hurricane or something like that at some point, hopefully not, but some more information there. Just a few more itemized deductions to cover. So all miscellaneous deductions which were subject to the 2% of adjusted gross income limitation have been suspended. Bottom line on these is we just weren't seeing very many people really getting the benefit of these to begin with. There's always exceptions, and some folks did, but for the most part, the higher income earners who had some of these just weren't getting much benefit for a couple of reasons. Obviously, you have the 2% of AGI limitation there, and number two, they were not allowed in computing alternative minimum tax. So between those two items there, you just, a lot of times we're not getting much tax benefit. So I don't know how many people are really going to be impacted by those lost potential deductions, but that's just something to note there. There's a listing there, those 3 points below, on what some of those items might be. Gambling losses. So for the most part, for recreational gamblers, there really has been no change. So deductions are still fully allowed to the extent of winnings. The provision that they've added really affects professional gamblers in that some of their other deductions, like travel expenses, if they have racing programs and things like that that they purchase that are part of their their trade of being a professional gambler, will have some additional limitations there. But again, for the recreational gamblers, nothing has changed. Those rules allowing the losses against the winnings, or to the extent of winnings, still stand. Okay, so here are a few planning items to consider. As I mentioned earlier, the new higher standard deduction means there will be fewer taxpayers that itemize. So bunching deductions in a single year to exceed the standard deduction will help maximize the efficiency of those deductions. One example of something that folks have been considering or may continue to consider going forward is using a donor-advised fund, and that would entail making larger contributions in years when you itemize. So a real simple example would be, let's just say I donate or make donations to my favorite charities on average of $5,000 per year, and rather than and assume I'm not getting any benefit for those deductions because of these new rules. Okay, I'm using the standard deduction every year, so I'm not getting benefit from my itemized. Well, as an example, I might say, well, I want to cover 5 years of those deductions in 1 year, at least for tax purposes. So I could contribute $25,000 to a donor-advised fund. Assuming that I have other itemized deductions, I can get benefit for that deduction once I fund it. And then through that fund, over whatever period of time, I'm just using 5 years as an example, I can spread those dollars to the organizations that I choose to, which is essentially the same thing I would have done before, except under this strategy, at least I'm getting some benefit from a tax perspective for making those, for using that donor-advised fund. So, you see that a lot more being used now just for this very reason. If I was making if I'm getting benefit for a $25,000 deduction and I'm in the top tax bracket, 37%, you're looking at potential savings of around $9,000. So it's something, folks, understandably have been considering. For some of the older taxpayers who are collecting required minimum distributions or taking required minimum distributions, they can make contributions directly to the organizations out of their IRA rather than pushing it through as an itemized deduction. So they're getting a direct deduction from income for doing that. And that's becoming a real popular strategy now, again, for those folks that historically would have been itemizing and just writing checks out of pocket to do that. This is certainly a strategy that can save some taxes. Healthcare savings accounts are listed there. Nothing new on that. It's just those are always good ideas, I think, if you're eligible to utilize one. One item that's not listed here, but maybe should be, is watching your mortgage interest. So if you're now in a situation that you're using the standard deduction, that mortgage interest isn't providing you any tax benefit. So if you're looking at your personal situation and you have cash sitting in a bank account that's earning less than 1% interest, and you have this mortgage interest out there that's not providing you any tax benefit anymore, it's maybe a time to at least consider just paying that mortgage off, since some of the benefits you were getting before are now gone. Okay, so moving on from itemized deductions and some planning things, so talk about a few income adjustments. First one there is alimony, some changes there. So alimony payments will no longer be deductible by the payer and no longer taxable to the recipient. And that will be effective for agreements executed after December 31st, 2018. So any existing agreements in place, no changes apply to those settlement agreements. Another item, moving expenses have been suspended. There's a military exception there for that. Roths, new rule there is we cannot unwind a Roth conversion. However, you can still convert from a traditional IRA to a Roth, but once you've done the conversion from an IRA to a Roth, you just cannot undo it any longer. Okay, moving on to more income adjustments. So distributions from 529 plans can now be used for elementary or secondary school, so up to $10,000. And just in general, I think our other folks here would agree. In general, these are great. If you plan on or you're pretty confident you're going to be funding the education for your kids or your grandkids, to put the money in these accounts and have the earnings grow tax-free for as long as you need to until they pull the dollars out for school, I think just makes a lot of sense rather than having those funds in accounts where you're paying tax on them. So just a note there. There's some more information there on allowable expenses, things like that for purposes of distributions. A few other items on the slide there that I think we can move past for this purpose because I think they're fairly unique. And getting on to some of just the Obamacare provisions, the individual mandate for health care or health insurance goes away after 2018. I know a lot of people are hoping this is the beginning of the end of Obamacare. Well, we'll see. A lot of people feel that's the case, and I hope it is, but like I said, we will see. I mentioned earlier, no change to the 3.8% net investment income tax and the additional 0.9% additional Medicare tax. So those still exist.